Hello and welcome to Quarterly Perspectives, Fourth Quarter 2020. My name is Justin Rice and I'll be your host for this presentation. The presentation is divided into two parts. The first part reviews recent asset class returns, and the second part looks at recent market and economic headlines. We begin our return discussion with a high-level look at a collection of major asset classes. As we can see from the illustration, U.S., international, and emerging market stocks all rose sharply during the fourth quarter. Quarterly returns for U.S. and global bonds were also positive. Next, I'll draw your attention to the upper right-hand portion of the graphic. The U.S. dollar was down 4.2% for the fourth quarter and down 6.7% over the past 12 months. Now let's look a little deeper at what was driving the returns of stocks and bonds. Our evidence-based investment process has us favor several factors of return. One of those factors is a preference for small capitalization companies versus large capitalization companies. History has shown that small companies tend to outperform large companies over the long term. Looking back over the past 5 years, we see that outperformance in developed international companies, but we didn't see it in U.S. and emerging market companies. Another factor of return we emphasize is value companies. Historically, value companies have outperformed growth companies over the long term. On these charts, we see a different story. When the lines are going up, value outperforms growth. When they head down, growth outperforms value. On the left-hand side of the graphic, we look at value versus growth in large companies. Over the past 5 years, large growth companies outperformed large value companies in every category. On the right-hand side of the graphic, we look at value versus growth in small companies. Over the past 5 years, only small value companies in emerging markets outperformed their small growth counterparts. While we expect our factors of return to always deliver positive results, realized returns are often different. This is why we diversify into multiple factors of return. Turning our attention to bonds, we start by looking at recent interest rates. Here we plot what is commonly referred to as a yield curve to show us how much interest we receive from bond investments with different maturities. The dark blue line represents interest rates at the end of 2019, and the light blue line represents interest rates at the end of the fourth quarter of 2020. And as we can see, interest rates remained low this quarter relative to the end of 2019. On this slide, we look at the absolute impact of different asset classes on a sample 65% stock, 35% bond index mix. With both stock markets and bond markets advancing in the quarter, we can see that all performing asset classes contributed to the overall gain. U.S. small cap stocks served as the largest contributor. As we reflect on 2020, one of the more overshadowed developments in the investment space has been that we've seen the dollars invested in passive U.S. equity strategies continue to surpass the dollars invested in active U.S. equity strategies. For this quarter's headline section, we'll look at why that is, including the role that ETFs, exchange-traded funds, have played in that development. Before we get into the details, though, we'll set the stage with how investors have changed their allocations in 2020. Using estimated net flow and total asset data from Morningstar, which is available through November 2020, we can get a rough idea of how investors in aggregate have changed their allocations. The chart on the screen shows by category, which is simply how Morningstar classifies each mutual fund or ETF, how much money has flowed in or out of each of these strategies. The first column has the total flows for November, the second column shows the trailing 12 months of flows, and the third column shows the total assets currently invested in each category. For example, using the top line, U.S. equity strategies added over $35 billion in November, have seen $225 billion of outflows over the last 12 months, and currently have roughly $10.4 trillion of total assets invested. Looking closer at this data, what we find is that during the month of November, investors plowed nearly $112 billion into long-term mutual funds and ETFs, as indicated by the bold line second from the bottom, all long-term. To put this in context, that was the second largest monthly tally behind January 2013's $117 billion, and the most that we've seen in the 8 months since the market's sharp sell-off in March. On the other side, money market funds had their 6th consecutive month of outflows, signaling that investors continue to move out of cash and into riskier strategies. However, another key point here is that the trailing 12-month flows for both U.S. and international equity strategies are negative. This means that investors are still taking less risk than they were at the end of 2019. So now that we have a rough idea of how investors have changed their strategy throughout 2020, let's look a little closer at how they're getting those exposures. Using the same data from Morningstar, we focus on the last 10 years of net assets for both passive and active U.S. equity strategies. What we see is that in 2019, the script began to flip towards exchange-traded funds for U.S. equity strategies. You see that in late 2019, the light blue line, which is the total amount invested in passively managed long-term strategies, overtook the dark blue line that represents actively managed strategies. It's worth noting that this is currently isolated to U.S. equity strategies. Other categories, like fixed income and international equity, continue to favor active strategies, but this is still a monumental shift from our perspective, as investors in aggregate are beginning to doubt the merits of a traditional active approach as more money has continued to flow towards passive strategies through the turmoil of 2020. So what's driving this? A major tailwind behind this growing disparity in total assets has to do with the increasing popularity of index investing, meaning that the strategy simply attempts to mirror the holdings of a designated index. One driver of this shift towards index investing is the rise of exchange-traded funds. Looking back at the last 10 years ending November 2020, we compared the historical total net assets invested in ETFs versus more traditional open-ended mutual funds. This is looking at the total amount invested in ETFs and mutual funds, excluding money markets and fund of funds, and for the record, it controls for survivorship bias. Any funds or ETFs that existed at the time are included in the totals. What we find is a continuing trend of strong flows into ETFs relative to open-end funds. If we compare how assets have grown over the last 10 years, we can see that ETFs have experienced considerably stronger growth than open-ended funds. Over 5x for ETFs compared to 2x growth for mutual funds. In fact, in November, ETFs shattered their flows record with $97 billion of inflows for the month, easily topping the previous record of $62 billion set in June of 2019. Overall in 2020 so far, the ETF and open-end flows divergence has been starkest among U.S. equity funds. Domestic equity ETFs attracted $118 billion for the year through November. By contrast, open-end funds suffered a whopping $345 billion of outflows over that same period. This trend puts open-end U.S. equity funds on track for their worst outflows in a calendar year, easily surpassing 2019's record of $180 billion. So tons of data, but why does this matter to us now? Because as the space has grown, the SEC offered better clarity around how fund managers can structure ETFs that has opened new doors to investors. While ETFs have grown in popularity, the investment vehicles have also evolved in other ways. An important part of this evolution stems from a late 2019 change in regulation from the SEC. It was then that the SEC established the ETF rule. Now, I don't want to get too in the weeds regarding the mechanics of exchange-traded funds and all the specifics of this ruling. We can do that at a later time. But an important part of the ruling allowed for greater flexibility in terms of how the fund manager trades and rebalances the portfolio on a daily basis. This was particularly important for one of our fund managers, Dimensional Fund Advisors, or DFA. With this ruling, they felt they could now implement and execute their investment strategies with the same flexibility and patience as they do in their traditional mutual funds. The result has been an expanded product offering, beginning with the 3 core ETFs launched in early Q4 and continuing in 2021 with the expected conversion of 6 of their tax-managed mutual funds to ETFs. We can see the funds that are expected to convert on the screen, with one of the most immediate benefits for our clients being materially lower fees for all 6 strategies. Now, keep in mind the fees on the screen represent Dimensional's management fee. The actual net expense ratio will be higher once we consider the other fees in a fund and ETF. Throughout the year, you'll hear more about ETFs, their similarities and differences with mutual funds, and considerations we take when designing your investment portfolio. This concludes our presentation for today. Thank you again for joining me, and make sure to tune in next quarter. To review this or past commentary, please see Personal Wealth Strategies YouTube channel. For more information, you can also visit our website at personalwealthstrategies.com.